Let's look first at the stock market. Okay, normal returns are unadjusted for inflation. Real returns are corrected for inflation and are thus a more accurate reflection of the growth in an investor's purchasing power. We are reading Common Mutual Funds, Common Sense on Mutual Funds. Common Sense on Mutual Funds. Let's start here. Stock market risk. Although the stock market's real rate of return has apparently been remarkably steady over long periods, the rate has been subject to considerable variation from year to year. To measure the volatility of these returns, we use the standard deviation of annual returns. Table 1.2 presents the year-to-year volatility of returns in each of the three major periods of stock market history and since 1982. Okay, this is pretty good. It also presents the all-time high and low annual returns in each period. From 1802 to 1870, returns varied from the 7% average by a standard deviation of 16.9%. In other words, real returns fell within the range of 9.9% to 23.9% about two-thirds of the time. From 1871 to 1925, the standard deviation of return was 16.8%, almost unchanged from the first period. In the modern era, 1926 to the present, the standard deviation of returns has risen to 20.4%. Wow. From 1802 to 2008, the highest annual real return. So from 1802 to 1870, the highest annual real return was 66.6%. Standard real time annual. Okay. So from 1802 to 1870, the stock market averaged a 16.9% return. Look at this, from 1926 to 2008, the annual average rate of return was 20%. Jeez. There's money to be made in the stock market. You have to know how to do it. You gotta read. Standard deviation, what is it? Standard deviation is the accepted academic measure of variability. It expresses the range of an investment's return over a given time period. For example, if an investment has earned an average annual return of 10% and two-thirds of its annual returns have ranged from -5% to 25%, a range of 15% points in either direction. One standard deviation is defined as 15. Two standard deviations would be the range that includes 95% of the annual returns. I don't even understand what that means, dude. I don't understand what that means. Okay, stock and returns. We are reading Common Sense on Mutual Funds by John Bogle. Common Sense on Mutual Funds. Here we go. Let's go to the bond market. Okay, so bond market returns. In the bond market, perhaps surprisingly, historical returns are far less consistent than stock returns. Since 1802, long-term U.S. Treasury bonds have generated real returns of 3.5% per year. During that time, however, returns have been subject to considerable variability. From 1802 to 1870, average annual returns on long-term U.S. Treasury bonds amounted to 4.8%. Wow. Let's get one more page in. Bond market risk. Okay. Hope you guys understand this. Bond market risk. Hand in hand with their lower returns, bonds have generally come with less risk than stocks. Okay. Bonds have generally come with less risk than stocks. So with less risk, that usually means less money. Remember that. But you won't lose money. So less risk means you will have less return. You'll gain less money, but you won't risk your money as much. High risk, high return. Low risk, low return. I mean, that's just the way it is. Okay, since 1802, the average annual standard deviation of bond returns has been 8.8%, less than half of the standard deviation for stocks. From 1802 to 1870, the standard deviation of bond returns with a modest 8.3%. In the second major period, 1871 to 1925, volatility declined slightly. The annual standard deviation was 6.4%. Since 1926, by contrast, the annual standard deviation of returns on bonds has risen to 10.6%. And from 1982 to 1997, it reached 13.6%. And in contrast to the historical pattern, surpassed the 13.2% standard deviation for returns on stocks during the same period. The departure from the historical pattern might be the result of rapid and dramatic changes in the inflation rate in the years that preceded and then punctuated this period. Although changes in the rate of inflation from period to period have done little to alter the real rate of returns in the stock market, they have had a profound impact on the real returns provided by bonds. A bond interest payment is fixed for the number of years specified until it matures and is repaid. In times of rapidly rising prices, the real value of this fixed interest payment declines sharply, diminishing the real return provided by the bond. If investors expect rapid inflation, they demand that the bond insurer pay a commensurately higher rate of interest. Bond returns. This is a good book. This is a book on how to make money. You got to make money in this life. Okay, that's it for now.